In this chapter, I'll be discussing some of the main concepts of retirement plans and annuities, and I recommend that you review the full set of PowerPoints as well as reading through Chapter 11 in the text. So let's get started. So Congress has enacted various kinds of tax incentives that encourage taxpayers to retire, build a retirement account, as well as to save for education, either for themselves or for their family members. We'll talk about some of the various types of retirement plans. Some are individual-based, such as IRAs, individual retirement accounts. Others are employer-sponsored, such as 401ks. Before we begin, let's take a look at some of the terminology in this chapter. One is an annuity, which is a series of equally spaced payments. Beneficiary is the one who receives the proceeds or the funds from an annuity, for example, or from a fund. Contributions are the amounts that builds the funds that are paid into the fund. Distributions are the amounts that are taken from the fund. A donor is someone who provides funds for the benefit of another. A tax-deferred retirement account. This is not a tax-free plan, but a tax-deferred means you're postponing the payment of tax on earnings. And a trustee is someone who manages or oversees a trust. Oftentimes the contributor to the trust and the trustee are the same person. I said earlier, tax-deferred does not mean tax-free. It just means a postponement of the tax obligation. Generally, untaxed contributions are taxed when distributed. So, for example, with a traditional IRA, if you contribute and you qualify, you get a deduction in the year of the contribution. Well, that would mean that when you take distributions from the fund, you will be taxed on it. Conversely, previously taxed contributions are generally not taxed on distributions, such as a Roth IRA, where contributions to a Roth are not deductible, so there's no tax benefit on the front end. But when the distributions are made, those distributions are not taxable. Various types of employer-sponsored plans are qualified pension and profit-sharing plans. We'll talk a little bit about those. 401k plans, very common. 403b, largely for government employees, for example. KEO plans for the self-employed. And the last two are simplified employee pensions, SEPs, and simple plans. These are used primarily by small employers. So plans do provide benefits to the employers and the employees. Employer gets an immediate deduction for their contribution on behalf of the employee. And on the tax side, the employer contributions are not considered compensation to the employee. Earnings from the plan investments are not taxed when earned. That's that tax deferment we mentioned earlier. And the plan assets or earnings are not taxable to the employee unless they're withdrawn, as long as the withdrawals and distributions are qualified, which we'll discuss later. Defined contribution plans, these are very common. They pre-establish the amount of the contribution itself, although the distribution is rather uncertain. Kind of depends on how well the fund does and how well funded it is over time. Defined benefit plans are what we might think of as traditional pension plans. These plans have an uncertain contribution amount, but the distribution is certain because it's based on a formula. And with a defined benefit plan, generally the employer bears all the risk of the performance of the funds. And however, the defined contribution plans, here the employee bears the risk of the performance of the fund over time. In order to qualify for an employer-sponsored plan, they must be non-discriminatory, and they'll have minimum vesting rules. A vesting rule is the time and period at which it takes to have a right to the funds contributed by the employer, and they can either be contributory by the employee or non-contributory. Additions to defined contribution plans cannot exceed the lower of $55,000 or 100% of compensation, and additions to defined benefit plans cannot result in benefits more than $220,000 or 100% of the average compensation for the highest 3 years. So to find employer plans, very common one I mentioned earlier was a 401k. They must meet the non-discrimination rules I mentioned earlier. The employee can elect to defer now up to $18,500, an additional $6,000 or up to $24,500 if the employee is age 50 or over. KEO plans are for the self-employed, and the contribution limits are $55,000 or 100% of compensation, whichever is less. The last two are for small employers. Again, these are employer-sponsored retirement plans, simplified employee pensions that the employer creates and contributes to the employee's IRA. Here the maximum contributions are 25% of up to $275,000 or $55,000, whichever is lower. And then simple plans for very small employers. They create an IRA or 401k. Here are some of the rules that relate to the simple plans. The employee contributes a certain percentage up to a maximum of $12,500. You can add an additional $3,000 for age 50 or over. And now the employer makes either a matching contribution of 3% for all the employees in the plan, or 2% for all eligible employees. Or individual sponsored plans for married taxpayers. If both are employed and neither are covered under an employer plan, then both spouses can make a deductible IRA contribution up to the $5,500, $6,500 limits. However, if one spouse is employed and the other is not covered under an employer plan, they can still contribute the maximum for both persons. If one spouse is covered under an employer plan and the other is not, the non-covered employee can still make and contribute, up to the maximum as long as AGI remains below $189,000. Roth IRA contributions are not deductible in any event, but the withdrawals are not taxable either, and nor are the distributions, of course. Contribution limits are the same, $5,500, $6,500 respectively for those under 50 and those 50 and over. And the phase-out starts for the Roth at $189,000 married filing joint, $120,000 single and head of household, and of course $0 for married filing separately. So the phase-out range is $10,000 for married filing joint. What that means is that the entire phase-out for married filing joint runs from $189,000 to $199,000. So above $199,000, the phase-out is complete, and the Roth IRA contributions are not possible. So if you look at in the text, these phase-outs ranges are listed as in the denominator of the formula. So, as I kind of alluded to earlier, contributions are deductible for traditional IRAs, but not for Roth IRAs. And distributions are taxable for traditional IRAs, but not for Roth IRAs. So there's kind of a trade-off between the two. I mentioned earlier that Congress and the government incentivizes taxpayers to also save for education. So contributions to Coverdell education savings accounts are not deductible, but their earnings over time are tax-free as long as the distributions are used to pay for qualified higher education expenses. So here's an example where the earnings may never be taxed. The limit on the CISA contributions, the Coverdell contributions, are $2,000 per beneficiary from everybody for that beneficiary. Here, though, the contributions phase out when AGI of the contributor reaches $190,000 and is totally phased out for married filing joint at $120,000. For single taxpayers, the contributions begin to phase out at $95,000 and are totally phased out at $110,000. There are other qualified tuition plans. 529 plans are pretty common. These are state-based plans for future education costs. Earnings can grow tax-free as well and can be used for qualified education expenses I mentioned earlier, and that includes things like books and supplies and tuition and room and board in this case. The beneficiary has to attend at least half-time, however. Distributions are taxed generally if there's an overarching rule that we use in tax code to determine whether or not a distribution is taxable. With some exceptions, generally, if the contribution is tax deductible, then the distribution will be taxable. If the contribution is not tax deductible, then the distribution may not be taxable. We'll be going through the simplified method in some of the problems I'll be demonstrating, which helps us determine how much of each distribution we receive is taxable. And we'll be using some of the tables in the text to do this. Plans such as traditional IRAs have required minimum distributions that begin on April 1st of the year following the year the taxpayer reaches age 70 and a half. So these required minimum distributions are based on life expectancies, and we normally use Table 3 in the text. And Table 3 is found on page 11-28. I'll be demonstrating those as well in the next video.